All right, everybody, welcome to the very first podcast of Olympus Wealth Strategies, where we help you take your finances to great heights. I'm John Sider, your host and founder of Olympus Wealth Strategies, and couldn't be more excited to kick things off with a great friend who also is a great business partner, Ryan Ripp. Ryan, he'll give us a little bit of color on himself, but he is the Chief Financial Officer for Flat Rock Global. They're a boutique firm, and couldn't be more excited to get this thing started with you, Ryan. So how about you tell us a little bit about yourself and your background?
Yeah, great. Excited to be here, John. Thanks for the invite. Excited to be on the inaugural Olympus podcast. So I've been with Flat Rock about 4.5 years. We are, as you said, boutique manager investing in kind of boutique or niche private credit strategies. I joined from a consulting background. I was in the financial services consulting practice, both at McKinsey and then Boston Consulting Group. Before that, I was an investment banker in New York City.
And Ryan's being humble, but he left out the most important piece, which you could probably see in his background. He'll say he's a graduate from Columbia Business School, but truly, he's a Notre Dame alumni. So we've got the best and brightest with us today.
I appreciate that.
So Ryan, everybody, whether it's your end clients who are advisors like Olympus, or my end clients, which are the individual investors, everyone's asking the question: what are your thoughts on the current state of the market? What's your outlook? What do you think there's things to watch for? Any thoughts on that as we're roughly 4 months into the year?
Yeah, I mean, we invest in, primarily collateralized loan obligations. So maybe I'll kind of focus there a little bit more so than the equity markets, which is not as much where we invest. But, I think there's a lot of parallels. I think what I'd say is choppy. And what I mean by that is day-to-day sentiment swings quite a bit. I think it's really just characterized by a lot of uncertainty right now. And folks are trying to understand, what's going to be the economic impact of these tariffs, both in terms of inflation and how monetary policy will react to that, coupled with its impact on the labor market. And so, I think you really see sentiment kind of moving day to day, both positively and negatively. So, for us, what we saw, with our market is, spreads widen. What that means is sort of the price of the securities we invest in had declined quite a bit. And we've seen some of that tighten back already since early April when all these tariffs were initially announced. And so, I'd say things are incrementally better and sentiment is incrementally better than it was when there was just a full kind of degree of shock and uncertainty in the market 3 or 4 weeks ago. But I really do think that kind of, that's a very fragile, sentiment right now. And it can kind of change with, the latest news flow or the latest tweet or anything like that.
Well, sure. Yeah. It seems like it's really like you're hitting on just headline to headline, right? And one of the headlines that, all of us advisors are reading, and I think is coming across, CNBC for people, in clients who are watching that, is this phrase saying that spreads are tightening. And yeah. I know we'll talk about, how you guys specialize in, private credit and collateralized loan obligations, but can you tell us what that even means and how that's actually impactful?
Yeah, what that literally means in terms of spreads tightening is it means that the coupon rates or interest rates you can get on fixed income investments are declining relative to where they were previously, right? So, for instance, if you were able to earn, call it 6% on, pick an investment grade bond 6 months ago, well, now there's more incremental competition and people wanting to buy that bond, so they're willing to buy it at a higher price, which translates to, all else equal, effectively a lower interest rate or coupon that you earn. And so, we'd seen spreads tighten, for a while. It's sort of been a theme in private credit and, the CLO piece of the market in our area for a while. And what you've seen is that there's just more and more money in investment firms chasing, a relatively finite amount of deals. So higher competition begets, higher prices for assets, which begets lower coupon rates, lower total, interest rates you can earn on these investments. I think what you've seen, fortunately, to some degree for us in the last month or so is, as a result of more of a risk-off sentiment in the market, you have seen spreads widen out a little bit relative to kind of the historical tights that we saw just, 6 to 8 weeks ago. And so we're getting a little bit of relief there, and we're able to invest just at, just at more normalized rates than we were 6 weeks ago, I would say 8 weeks ago.
Well, and we're going to dive into your funds today, but maybe you can give us some context as we talk about who FlatRock Global is, a little bit more details as far as, what you all specialize in. We're talking about interest rates, what is maybe an interest rate that one of your funds is producing for investors, especially when we think about those who are, a lot of us work with retirees who are, trying to supplement their income through their investment portfolio. What's kind of an interest rate that is common amongst the FlatRock funds, maybe versus a traditional bond fund?
Yeah, sure. So, FlatRock, we have 3 different funds. They're all structured the same as interval funds, and happy to get into what that means. But all 3 funds they're meant to produce income. So, they really do, they are focused on generating income as opposed to capital appreciation. And they just run a bit of a spectrum in terms of, expected return and expected, volatility or expected risk, right? And so, the rates of return that our funds pay kind of span sort of the lower end, kind of a 9% interest rate right now, or 9% distribution rate, I should say. And at the high end, we have a fund that pays about a 14.5% distribution rate. But what comes with those different distribution rates is you should expect more or less volatility in terms of how the share price of our funds behave because of the investments that we own in each of those funds and how they vary.
Well, it on the onset seems attractive for potential suitable investors as far as the interest rate's concerned. So let's kind of dive into FlatRock Global, who you guys are, how long you've been around, and kind of the depth that you all have on the team.
Yeah, absolutely. So we are a relatively small team. We're about 15 people total. The firm was formed in 2016 and actually launched our first fund in July of 2017. Since then, we've grown from effectively zero in assets to about 1.5 billion of assets today. So great growth that we're excited about, but certainly still a relatively small player compared to some of the large firms out there. As I said, we have that money or that capital spread across 3 different investment strategies. And we have an investment team of about 6 people supporting those strategies, as well as, a number of folks that work in business development, as well as finance and operations. Our intention is always to be sort of a smaller boutique manager. The saying that our CEO likes to say is, we don't want to be BlackRock, we want to be FlatRock. We're a small team. We have a tight-knit culture. We really enjoy working together and really have no plans or ambitions to make this a 20, 30, $40 billion firm. We really like the way things are going and want to grow at a measured and, manageable pace.
Yeah, and I was going to say one thing that was impressive, and just so everybody knows, I've actually met everybody on the FlatRock team a couple different times doing some due diligence. And not only was that impressive, but when I got to talk to the CEO, Bob, I asked him, how are you able to run a multi-billion dollar fund when you have your team spread out across the country? And he said something really interesting, Ryan. He said, the best talent doesn't live all in one city. And I just thought that was a unique way to take, maybe coming out of the, I know you guys formed pre-pandemic, but coming out of the pandemic world where there are a lot of people were working from home, but now you've seen the likes of, the major, call it Wall Street firms have called everybody back into the office, but you guys are able to operate at a very high, very niche level, being somewhat of a remote firm.
Yeah, no, that's absolutely right. I think the fact that, we are a smaller firm that allows us to, work in this remote environment, and, it's clear what everyone's responsibilities are when you have a team of only 15 and nobody can really hide. But, Bob was right when he said the best talent doesn't all live in the same place. And so, if you think about where a number of our folks, live and work, so, our number 2 on our CLO investment team, Derek Russo, is a director. He lives out in the Seattle area, right? And he is a really smart, great investor in structured credit, specifically in CLOs. But, if we were a New York-based firm, Derek has no intention to move back to the East Coast, so we would never have been able to hire him, right? So having this remote model really works for us to be able to add folks like Derek Russo to our team.
Oh, yeah. And I think as we talk about the competitiveness of, finding the best applicants and the best talent pool, if you have the skill sets, and obviously it seems like Flat Rock is not a place where you have your first job out of college, right? All of you are very consummate professionals. But it seems like that's a great way to be able to take talent and bring talent in-house if people don't want to, live in the New York Cities or the Los Angeleses of the world.
Yeah, we only myself and one other person are actually in the tri-state greater New York area. Everybody else is pretty spread out at this point.
So you mentioned something about, to start this off, when you gave the economic outlook as far as private credit. A lot of people listening are not going to know what that is. Can you give us just a high-level breakdown of what is private credit and what does that ultimately mean?
Yeah, I mean, I think private credit, the term is expanded to mean a lot of things to a lot of different people. But I think in its simplest way, what I'd say is private credit is lending done by non-bank lenders, so mostly private investment firms. Think Blackstone or Ares or someone like that. To companies. These loans are structured and arranged in a private fashion, so away from the public markets. And these loans can't be traded in any sort of exchange. There's no liquidity for these. So, these are transactions that are arranged privately between non-bank lenders that, are illiquid and cannot be traded. That's the simplest way I would define private credit. Also, most of these loans typically are not rated by rating agencies like Moody's and S&P. And when you compare that to what we call broadly syndicated loans, those are often made by banks to large companies, and then those loans might be syndicated out to other investors. And those loans, one, can be traded and are traded daily. And also those loans typically are rated by a Moody's and S&P or a Fitch.
So when you talk about that, does Flat Rock invest in broadly syndicated loans, or is it a mix between the two?
Yeah. So, through our CLOs is where we have most of our loan exposure, right? And so I would say, we invest in both. We invest in CLOs that own portfolios of broadly syndicated loans. We also invest in CLOs that own portfolios of, private credit or middle market loans. I'd say we have a bias toward private credit loans for a number of reasons, and happy to get into that. But we do own a little bit of both for different reasons.
So let's talk about private credit in that context. Can you elaborate on that last point a little bit?
Yeah, just in terms of owning these loans via CLO structure? Sure. So, a CLO, I think people, they hear a three-letter acronym that starts with C and ends with O, and they think of the things that happened in 2008. And while there are structural similarities, like CLOs are quite different in terms of, one, how they performed during the Great Financial Crisis, and two, the collateral they actually own. So, folks overcomplicate what a CLO is, but a CLO really is a portfolio of loans that's put together. And then the interest payments the interest in those loans is sold to different investors who each agree to take, an interest in the cash flows of that portfolio of loans. Some of those interests are going to be more senior or junior to each other, i.e., one person gets paid first and one person gets paid second. But in exchange for taking that first position or second position or third position in terms of receiving those interest payments on those loans in that CLO loan portfolio, you earn a different rate of return. So, maybe someone in the first position, owns a CLO note rated AAA, and they might receive, kind of an all-in yield of, depending on where the market is, 4 or 5%, right? But then you might have someone like we like to invest in the BB notes and the equity, which are folks that get paid, later or have the kind of lower claim on the interest payments from the loan portfolio. And we receive, all-in returns of 10, 12, even 15, 16%, depending on the investment. So, you take a greater degree of risk, but you can earn potentially higher returns. And so, that's really what a CLO is. It's a loan portfolio or a loan fund in which different investors agree to take just sort of different, we call them tranches, but you can think of them as share classes. And those share classes get paid, first or second or third, and they get different rates of return in exchange for that different level of risk. Does that make sense?
Perfect sense. Yeah, you broke that down well. So as far as those different rates of return, maybe that's a good segue into the different funds that Flat Rock has. So can you talk about the three different funds and kind of the high level notes on each one?
Yeah. So, as you said, we have three. As I said earlier, span this spectrum in terms of expected return and just expected volatility of the share price. So, at the lower end of the spectrum, we have our Flat Rock Core Income Fund. And so what I would describe this as is like a diversified private credit fund with a tilt toward middle market lending. So, roughly half, maybe a little bit more of the portfolio is going to be, directly originated middle market loans, right? So loans, private credit loans to private companies in the middle market. And those loans, you typically see that the marks on those don't move around very much, right? And then in addition to that, the other half of the portfolio is going to be, a mix of other securities, mostly CLO securities, but CLO securities that we expect to be less volatile in terms of their price, such that, all told, when you aggregate all that together on a day-to-day basis, you don't see the share price of that fund, or we wouldn't expect to see the share price of that fund moving around very much. But in exchange for that, we definitely pay a little bit lower of a distribution rate in that fund. But it's really meant to be a fund where you can, just feel good about receiving your monthly distribution from the fund and not really have to worry or watch the share price move around very much. So then, if we walk up the spectrum a little bit, we have our Flat Rock Enhanced Income Fund. So this fund's been around only a little over 2 years, but it's already become, I'd call it our flagship. It's become our largest quickly. And this fund invests primarily, and right now almost exclusively, in CLO mezzanine notes. So as I was talking about earlier, you have, different share classes or tranches within the CLO. This is one of the more junior tranches, or one of the tranches within a CLO that would get paid, kind of last or second to last. But in exchange for that, you can earn higher rates of return. So this fund, has been able to pay historically a yield of, 10% plus, right? A little bit lower right now because of how tight spreads are, but, hopefully we can bring that back up over time. But, it's sort of a little bit more of a volatile fund. And the prices of these notes that we own in this fund are going to be a little more volatile. So our share price is going to be a little bit more volatile. But, over a long horizon, I'd expect the distribution rate to be higher than our Flat Rock Core Income Fund, right? And then last, all the way up in the spectrum is our Flat Rock Opportunity Fund. And this fund invests in something called CLO equity. So this is, in these different tranches within the CLO, this is the tranche that gets paid last. And only gets paid if there's enough cash and interest to be made to all the investors in the CLO that are more senior. But in exchange for taking that more risky, position, you also receive all of the excess income every quarter from the CLO. And if the CLO's portfolio of loans is performing well, that can be a return of 15 to 20%. So, really high potential cash on cash returns. And that's why we're able to, in this fund, pay a distribution yield of, 14% plus today.
Well, Ryan, you mentioned obviously there's different levels of risk, but I want to bring us back to kind of earlier in the conversation. You mentioned volatility and you mentioned interval funds. And so can you help us understand Flat Rock Global is structured in interval funds. What is an interval fund? How is that maybe different than some of our listeners who understand the kind of, I'll call it the traditional private credit structure fund, and then maybe some who are familiar with CLOs, but they might be familiar through an ETF structure. And can you kind of delineate how you guys are different and why you chose the fund structure that you did?
Yeah, so we opted to go with an interval fund structure because we felt it was a good match for two things. One, for, independent RIAs like, yourself, John, and Olympus, who we like to work with. Operationally, it works well, and happy to get into that. But also a little more shareholder friendly than, sort of the long-term locked up funds where you have to put capital in, like a traditional GPLP fund, and you don't get that capital back for quite a while, right? So an interval fund, it sort of looks a little like a mutual fund in some respects because the shares aren't traded the way in ETFs, shares are traded. But every single day, at the end of the day, we put a valuation on the shares of the fund. We basically, look at all the assets in each of the portfolios and we say, the net asset value of each share in the fund today is worth X. And anyone that day that wants to buy the fund, well, they put in their orders via Fidelity and Schwab and Pershing and other platforms. And all of those orders get executed at that same net asset value that we report at the end of the day. So, any RIA such as yourself can allocate to any of our interval funds with the click or a couple clicks of a button, which operationally I think is a lot easier for you than having to fill out paperwork on behalf of clients. So, we think that's favorable. But then the difference is that versus a mutual fund is that you can't sell every day. You can only sell your shares once a quarter during a tender period. And this works well because the assets that we own in these funds tend to be less liquid, right? We can't just at a moment's notice, sell everything in our portfolio to convert it to cash, on the same day, the way you could if you owned a portfolio of stocks or investment grade bonds or something like that, right? And so, an interval fund allows us to plan for exactly how much money we'll need to have to meet investor redemption requests and to know the day on which we'll have to meet those investor redemption requests. And that means that, we can plan for and build enough cash or liquidity in the fund over time to meet that redemption request that we know is coming. And also it allows us to avoid having to, sell assets in periods of market dislocation and lock in losses for investors in the fund, right? So if you think
as opposed to like an ETF structure where if the market's going, haywire one day and the CLO ETF that's out there, that could experience significant volatility where maybe your day or week or month's worth of volatility could be substantially less because there's not kind of this run on the market, if you will.
Yeah, I think it's a little bit, it's not even so much the volatility because we do have to mark our book every single day. So you would see the volatility in the share price. But what it means is we don't have to sell assets and crystallize losses in order to meet redemptions, right? We can, we have time to allow the market to sort of come back and recover and, not have to, fire sale assets when the market's down 15% to meet a bunch of redemptions.
So really this limited liquidity, if you will, in times of market dislocation can actually be favorable to the investor to not have, like you said, a fire sale on the asset.
Yeah, exactly right. That's how we think about it for sure.
So let's kind of talk about maybe a little bit more about how private credit and CLOs play into portfolios for individual investors.
Yeah, sure. So, what you've seen, anecdotally from our experience, and we have, roughly 150 different RIAs that are clients, and we talk to many more than that every year, is that, you've seen more and more RIAs and, financial advisors overall just looking to use private credit in their clients' portfolios. I think the real reason for that is, you can really get materially higher yield potentially in private credit than you can get in more traditional, traditional bond funds for sure. And you can also get, there's sort of a broad spectrum of opportunity sets out there. So you can really get a lot of different types of exposure via private credit that you can't get via more traditional risk asset classes.
And so obviously from the time you've been in the business from analyst to consulting, but now with FlatRock, there's been this huge wave of, from all the 150 plus RAs, independent firms that you work with, this kind of further adoption of private credit. Mm-hmm. And so where you were all at when you founded FlatRock to today, there's been a huge increase. But where do you see maybe the market outlook for private credit as we look forward over the next several years or decade?
Yeah, so, it's funny, we've seen it grow a lot, but it still feels very much like the early innings. When I think about what it was like for the firm, when I got here in early 2021, or what it was like even before that, before I got here, but, when I knew Bob and was talking to him about what it was like to raise money, the question you'd have to answer for RAs when you'd go into their office and sort of pitch these products to them is, what is private credit, right? And they didn't even know. So it was really that kind of education. And now the question a lot of times is, why private credit? Why should I invest in private credit? I know what it is. Tell me why I should invest in private credit or invest in your funds, right? Or, we just get more inbounds these days from advisors saying, hey, I'm starting to kick the tires and exploring allocating to private credit. I'd like to learn more about your fund. But it's still, as I said, it's still a lot of folks that are early and new to the game, and a lot of folks that don't have it in their clients' portfolios yet. So while the adoption is much higher than it was 5-6 years ago, I still think there's a long way to go.
Yeah. So as far as what I really like with what FlatRock does is you guys are a great source of education. And so maybe talk about how that is kind of a cornerstone of the firm, and if people wanted to learn more, where they could seek some more information.
Yeah, absolutely. So I think when you have products like collateralized loan obligation funds that you invest in, that requires education to get people familiar with the asset class and why it could potentially be interesting, right? So we spend a lot of time trying to educate people on private credit and CLOs and the sort of packaging of private credit loans into CLO structures. And we do that via a number of different ways. We do periodic webinars, we publish white papers, but I think the two things that we do that are most unique are our chief investment officer wrote a book about CLO investing. You can buy it on Amazon if you're interested.
Great book, by the way.
Yeah. Riveting. Great page turner. No, but I mean, it is very informative if you're looking to get up to speed on the asset class. So, Shiloh Bates, our CIO, wrote that book. And then also, we actually launched a podcast series that you can find on Spotify, Apple, et cetera, kind of your typical podcast distribution platforms, Amazon, called The CLO Investor. And it's just, interviews and conversations between Shiloh, or CIO, and various members of the investment and the banking community around the structured credit and CLO space. And they're usually pretty short, 20, 30 minutes, pretty punchy conversations. And, I've definitely learned a lot listening to them myself.
Well, Ryan, thank you so much for your time. Is there anything else that you want to leave our listeners with?
No, I don't think so. I really enjoyed the conversation and, excited to be on the inaugural podcast for Olympus.
Yes. Well, hey, thank you so much, Ryan, and appreciate everybody listening. And if you all have any questions, feel free to reach out to us at Olympus Wealth Strategies, and we're happy to address anything that comes up. But Ryan, thank you so much for your time, and hope you have a good day.
Thanks, John. Thanks for having me.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.